A married couple, both 65 or older, can take in $146,400 this year and owe the federal government nothing, not a reduced amount, nothing. Now, before you think old Vern has finally lost the thread, let me show you the receipt. Because every piece of this comes straight out of the IRS numbers for 2026. Start with the standard deduction for a married couple, $32,200. Add the extra amount the tax code gives people 65 and older. That's $1,650 per spouse, so $3,300 for the two of you. Add the new senior deduction that came out of the 2025 tax law. $6,000 per person, $12,000 for a couple, and it runs through 2028. Sack those three and you get $47,500 of income shielded before anything is taxed at all. Now here's the piece almost nobody puts together with the rest. Long-term capital gains, the growth on things you've held more than a year, ride their own rate schedule, and the bottom rung of that schedule is 0%. For 2026, a married couple with taxable income at or below $98,900 pays zero on those gains. $47,500 plus $98,900, $146,400. Now, let me be honest with you about one thing, because I'd rather you trust me than be impressed by me. The IRS did not issue a press release with that number on it. What they published was Revenue Procedure 2025-32, which contains all the pieces. The number is what you get when you add the pieces up. Every component is official. The total is arithmetic. And here's why practically nobody actually collects it, which we'll get to in detail. It only works if your income has a very particular shape. Get one ingredient wrong and the whole thing collapses down to something ordinary. I'm Uncle Vern, and today I'm going to show you exactly how this works, exactly who it works for, the three things that break it, and the narrow window where it's sitting there waiting. If you're between about 60 and 75, and especially if you've got investments sitting outside your retirement accounts, this is your video. Here's what we'll cover: the 4 layers that build the number and where each one comes from, why the actual cash you can pull is considerably larger than the headline figure, the exact profile of the person this works for, and why so few people are that person at the right moment, the 3 ways it falls apart, and the version of the number if you're single, which matters more than most people realize. Stick with me to section 4, because that's where I show you the $3,600 razor's edge this whole thing balances on. Miss it and you lose more than you gained. Grab a pen. Let's get into it. Section 1, the 4 layers. Let's slow down and build it properly, because if you understand the structure, you'll be able to run your own numbers instead of taking my word for it. There are 4 layers, and they stack. Layer 1, the base standard deduction, $32,200 for a married couple filing jointly in 2026. Everybody gets this. Layer 2, the age addition. The tax code has always given a little extra to people 65 and older. For a married couple, it's $1,650 per qualifying spouse. Both of you over 65, that's $3,300. Worth noting, each spouse checks their own box independently. If one of you is 66 and the other is 62, you only get one of them. Layer 3, the new senior deduction. This came out of the tax law signed in July of 2025. $6,000 per person aged 65 and up. It's separate from Layer 2 and stacks on top of it. And it's available whether you itemize or take the standard deduction. 2 things to write down about this one. It has an income phase-out, which is the razor's edge I'll cover shortly. And it's temporary. It runs for tax years 2025 through 2028, and then it's scheduled to disappear unless Congress extends it. Those 3 layers together, for a couple both over 65, come to $47,500. Layer 4, the 0% capital gains bracket. This is the one people don't know about, and it's the biggest piece. Money you make from selling something you held longer than a year does not get taxed like a paycheck. It has its own schedule, with 3 runs: 0%, 15%, and 20%. Qualified dividends ride the same schedule. For 2026, a married couple with total taxable income at or below $98,900 sits on that bottom rung, 0. A single filer gets 49,450. Now, here's the mechanical detail that matters, and I want to be precise. That 98,900 is the ceiling on your taxable income, which is what's left after your deductions come off. And your ordinary income stacks underneath the gains, filling that space up first. So if you already have $70,000 of ordinary income, you don't get a fresh $98,000 of room for gains. You get what's left underneath the ceiling, which is about $29,000. That detail is the entire reason most people never touch this. Hold on to it, because it comes back in Section 4. Add layer 4 to the first three, and there's your $146,400. Section 2. The catch that makes it bigger. Now I'm going to tell you something that sounds like a catch and is actually the best part. That $146,400 is not the amount of stock you can sell. It's the amount of gain. Big difference. Let me show you. Say you and your spouse bought a mutual fund years ago for $150,000, and today it's worth $300,000. If you sold the whole thing, your gain would be $150,000. The other $150,000 is your own money coming home, and it is not income. It was already taxed decades ago. The IRS has no further claim on it. So a couple in the right situation could sell close to $300,000 of investments, receive that money in their checking account, and no zero federal income tax on the transaction. Read that again, because it does not sound like it should be legal, and it is completely routine. The amount of cash you can pull is your gain limit plus your basis. And for most people who have held investments a long while, the basis is a big share of the account. Now, this also means you need to know your basis. Your brokerage tracks it, and it's on the statements, but a lot of folks have never looked. If you inherited the investments, your basis was very likely stepped up to the value on the date of death, which can mean the gain is far smaller than you'd guess. Which brings us to the obvious question. If this is real, and the number is this large, why is almost nobody collecting it? Section 3. Who this actually works for. Here's the honest answer, and this is where most videos on this subject stop short. The strategy needs a specific person. Let me describe them. They are married, and both are 65 or older. That's required for the full $47,500 of deductions. They have money in a regular taxable brokerage account, not just IRAs and 401ks. This is the big one. Capital gains treatment only exists outside retirement accounts. Every dollar that comes out of a traditional IRA is ordinary income, no matter what it was invested in. And here's the last requirement, the one that quietly disqualifies most people. They are not yet drawing Social Security. Why does that matter so much? Because Social Security benefits get pulled into your taxable income once your other income crosses certain thresholds, and those thresholds are low. $32,000 and $44,000 for a married couple, and they were set in 1983 and have never once been adjusted for inflation. So the moment Social Security is running, you've got ordinary income stacking underneath your gains, eating up the room under that 98,900 ceiling. The 0% band shrinks accordingly. So picture the person this works for. A couple in their late 60s. Both on Medicare, so the health insurance problem is solved. Delaying Social Security toward 70 so the checks grow. Living off a brokerage account in the meantime. That's a real person. It's a lot of the people watching this, but it's also a narrow window, roughly ages 65 to 70, and it slams shut the day they claim. And now you know why nobody claims it. Most people file for Social Security before 67. They're through that window before they ever knew it existed. And plenty of others have all their money inside IRAs, so they never had a capital gain to harvest in the first place. It's not hidden. It's just that the people who qualify are usually only in the room for about 5 years, and nobody tells them while they are in there. And I want to add one more reason, because it's the one that bothers me most. A lot of good, careful people spend those exact years doing the opposite of this. Here's the pattern I see. Somebody retires at 64. They've been told their whole life not to touch the retirement accounts, so they don't. They've also been told that selling investments means paying tax, so they sit on the appreciated stock and live off their savings account instead. They spend down the cash. They leave the brokerage account alone because touching it feels expensive. And they file for Social Security at 65 because it feels safe and guaranteed. Every one of those decisions feels responsible. Together they walk a person straight past the open door and lock it behind them. The cash they spent was already tax-free, so spending it first bought them nothing. The stock they protected was sitting on gains they could have realized at zero. And the Social Security they turned on early both shrink the check permanently and arm the very thing that closes the window. That's not carelessness. That's what happens when the safe-sounding advice is the wrong advice for your particular 5 years, and nobody was in the room to say so. Section 4. The 3 things that break it. All right, here's the section I promised. 3 ways this falls apart, and the first one is the razor's edge. Break 1. The $150,000 line. Remember that new senior deduction, the $6,000 per person? It has an income phase-out. It starts shrinking once your modified adjusted gross income passes $150,000 for a married couple, at a rate of 6 cents for every dollar over. Now look back at our number, $146,400. That is $3,600 below the line. $3,600 on a $146,000 plan. So if you realize a little extra gain, or a dividend comes in bigger than you planned, or you forgot about some interest income, you can slide over that line and start losing the very deduction the strategy is built on. And as the deduction shrinks, your taxable income rises, which can push gains up out of the 0% band, which costs you again. This is why I tell you to aim well under the maximum. Do not drive at the guardrail. If somebody tells you to fill it to the last dollar, they haven't thought about what happens at $150,001. Break 2. Ordinary income stacking underneath. We covered the mechanic, but let me make it concrete. A pension counts. A traditional IRA withdrawal counts. A required minimum distribution counts. Wages from part-time work count. Interest from a savings account counts. Short-term capital gains from anything you held a year or less count as ordinary income too. Every one of those fills the space under the ceiling before your gains get there. So a couple with a $40,000 pension does not get the same number. Their room for 0% gains is dramatically smaller, and their picture is a different picture entirely. Break 3. Everything else the income touches. The gain may be taxed at zero, but it is still income for other purposes, and this trips people badly. It counts for Medicare's income-related surcharge, which looks back 2 years. For 2026, the first tier is $218,000 for a couple, so at $146,000 you're clear. But you should know the line is there. It counts for health insurance subsidies if either of you is under 65 and on the marketplace. And this one is brutal right now, because the enhanced subsidies expired at the end of 2025 and the old hard cliff is back for 2026. $1 over 400% of the federal poverty level and the whole credit is gone. A big gain harvest would blow straight through that. This is precisely why the strategy fits people who are already 65 and on Medicare. And it counts for your state. Most states tax capital gains as ordinary income, with no special 0% rate. So federal zero does not mean zero. Check your state before you do anything. As I record this, by the way, the House passed a 3-year extension of those health insurance credits back in January, but it stalled in the Senate. Check where that stands before you plan around it. And a fourth one, which is really a competition. Here's a tension nobody warns you about, and it catches the people who have been doing everything right. If you've watched my other videos, you know these same gap years are the best years for Roth conversions. Move money from the traditional IRA into a Roth while your income is low, pay 12% on it, and shrink the forced withdrawals waiting for you at 73. Now notice the problem. A Roth conversion is ordinary income, and ordinary income stacks underneath your capital gains, filling the room under that $98,900 ceiling. So every dollar you convert is a dollar of 0% gain room you just gave up. The two best strategies available to you in these years are standing on each other's feet. You cannot maximize both, and I'd be lying to you if I said there was a simple rule for which one wins. What I can tell you is the rough shape of it. If most of your money is trapped in traditional IRAs and your future required withdrawals look large and threatening, the conversions usually matter more because you're diffusing a problem that compounds. If your traditional balance is modest and you've got a big appreciated brokerage account, the gain harvesting often wins, because that basis reset is permanent and it protects the survivor. Most people land somewhere in the middle and do some of each, year by year, depending on what the numbers look like that January. But you have to choose deliberately. Drifting into it means doing neither one well. Section 5. The single filer version. I want to spend a minute here because the people who most need this number are the ones least likely to hear it. If you're single, and that includes a great many widows and widowers, the same structure works. The numbers are just smaller. Base standard deduction, $16,100. The age addition for a single filer is larger per person, $2,050. The senior deduction, $6,000. That's $24,150 in deductions. And the 0% capital gain ceiling for a single filer is $49,450. Add them, $73,600. Now here's what I want you to notice, and it's the thing that makes me want to bang the table a little. $73,600 is almost exactly half of $146,400. Not quite. It's $400 more than half, because the tax code gives a single person a slightly larger age addition than it gives each spouse in a couple. $2,050 instead of $1,650. But $400 of mercy on a $73,000 cut is not mercy. It's a rounding error. When a spouse dies, the survivor keeps the same house, the same investments, and usually most of the same income. But every threshold in their life cuts roughly in half. The deductions, the brackets, the 0% gain ceiling, the Social Security thresholds, the Medicare lines, all of it. Planners call it the widow's penalty, and it lands on the person having the worst year of their life. So if you're married and watching this, there's a version of this strategy that's really about the survivor. Using these years to harvest gains at zero and reset your cost basis higher means less taxable gain sitting there later, when whichever one of you is left is working with half the room. And if you're already single, don't skip this. $73,600 is still a serious number. And the narrower your brackets, the more every dollar you place correctly is worth. Section 6. Ray and Denise, and what they actually did. Let me put this on real people. Names change, numbers rounded. Ray is 67. Denise is 66. Both on Medicare. Ray retired at 63, Denise a year later. Here's their picture. They spend about $72,000 a year. The house is paid off. Neither of them has claimed Social Security because they decided to let Ray's grow until 70. Ray has a small pension, but it doesn't start until 70 either. Their accounts, $380,000 in a taxable brokerage account with a cost basis of about $210,000, so roughly $170,000 of unrealized gain. $520,000 in Ray's traditional IRA, $110,000 in a Roth, $40,000 in cash. So for these few years, they have almost no ordinary income, which puts them in exactly the room we've been describing. Here's what they did this year. They sold about $150,000 worth of the brokerage account. Because their basis was a bit over half, the gain on that sale was around $67,000. They had about $4,000 of interest in non-qualified dividends, which is ordinary income and stacks first. So their taxable income landed comfortably under the $98,900 ceiling, and their total income stayed well below that $150,000 phase-out line. They deliberately left themselves room rather than crowding the edge. Federal tax on that $67,000 of gain? Zero. And they now have $150,000 sitting in cash, which covers their spending for 2 years, from which the government took nothing. But here's the part I like best, and it's the part people miss. They didn't spend all of it. They took about $90,000 for living expenses and immediately reinvested $60,000 back into the market. Why? Because when you sell and rebuy, your cost basis resets to the new higher price. That $60,000 now has almost no built-in gain attached to it. They permanently erased the future tax on growth that had been accumulating for 15 years. That's called tax gain harvesting, and it's the mirror image of the tax loss harvesting you hear about every December. Nobody talks about the gain version because it only makes sense in low-income years, and most people are only in one for a short stretch. Ray and Denise have about 3 of these years before Social Security and the pension turn on. They intend to use every one. Section 7. 4 things people get wrong about this. Before we get to the how, let me clear up the objections I know some of you are already forming, because I've heard all of them. If I sell, won't I owe tax on the whole amount? No, you owe tax on the gain only, and in the scenario the tax on that gain is 0. Your original investment comes back to you as your own money. This is the single most common misunderstanding about brokerage accounts, and it keeps people frozen on appreciated stock for decades. Doesn't the money have to stay invested to count? No, once you've realized the gain and it's been taxed at 0, the money is yours to do anything with. Spend it, move it to savings, reinvest it, give it away. There's no holding requirement attached to a 0% gain. If it's taxed at 0, why does it show up on my return at all? Because 0% is a rate, not an exemption. The gain is income that appears on your return, and it counts toward the calculations we talked about in Section 4. That's why the phase-out and the Medicare line still matter even though the tax itself is nothing. A lot of people assume a 0 rate means invisible. It doesn't. My advisor never mentioned this. Maybe not, and there's often an innocent reason. Tax gain harvesting only makes sense in a narrow set of low-income years, and it produces no product sale and no fee. It's also handled by your tax preparer side of the house rather than your investment side, and those two people frequently do not talk to each other. Which is worth a moment. The person managing your investments usually isn't looking at your tax return. The person doing your tax return is usually looking backward at a year that already happened in March, when it's too late to change anything. This strategy lies in the gap between them. It has to be decided in the year, not after it, by someone looking at both sides at once. If nobody in your life is doing that, it may be worth being that person yourself, or paying somebody for one afternoon a year to be it for you. Section 8. How you'd actually do it. Practical steps in order. 1. Find your basis. Log into the brokerage account and look at cost basis by holding. You need to know how much of that account is your own money versus growth. Some of the older holdings may show as uncovered or missing basis, which means you'll need old records. Start looking now, not in December. 2. Add up your ordinary income for the year. Pension, any IRA withdrawals, part-time wages, interest, non-qualified dividends, Social Security if it's running. That's what's filling the space underneath. 3. Do the subtraction. Take your deduction total, $47,500 for a couple both over 65. Figure out where your taxable income sits after that. Then see how much room is left under $98,900. That remaining room is your 0% gain capacity. 4. Leave yourself a cushion. Aim to land several $1,000s below both ceilings. Dividend surprise people in December. 5. Use specific lot identification. When you sell, most brokerages let you choose exactly which purchase lots you're selling. Choosing high basis lots means less gain per dollar of cash raised. Choosing low basis lots means more gain harvested per dollar. Which you want depends on your goal that year, but the default setting usually isn't the one you'd have chosen. Look at it before you place the order. 6. Decide what to do with the proceeds. Spend it or sell and immediately rebuy to reset the basis higher. There's no wash sale problem when you're harvesting gains, because the wash sale rule only applies to losses. 7. Get it checked. I mean this. The interaction between the phase-out, the stacking rules, your state's treatment, and your Medicare look-back is genuinely fiddly, and the failure modes are expensive. This is a few $100s of a professional's time to protect a 5-figure benefit. Section 9. What this is really for. Let me step back from the arithmetic for a minute. I've watched people get very excited about a number like this and then do something a little foolish with it, which is to build their whole retirement around the tax result instead of around their life. So here's the frame I'd offer. This strategy is not free money. It's a discount on money you already had. That brokerage account was always yours. The gains were always yours. What the tax code is doing, in these specific years, is letting you convert them to cash without taking a cut. Which means the right question isn't how much can I harvest? It's what do I actually want this money to do? For most people, the honest answer is one of 3 things. It funds the years before Social Security starts, so the checks can keep growing. It resets your basis so your heirs or your surviving spouse inherit a cleaner situation. Or it pays for something you actually want to do while you're still able to do it. That third one is the one I'd push you toward, and here's why. These window years, from about 65 to 70, are not just the best tax years of your retirement. They're usually the best physical years of it too. You're on Medicare, so the insurance fear is behind you. You've stopped working. And you can still do the trip, the project, the long drive to see the grandkids. I've never once heard somebody in their 80s say they wish they'd harvested more capital gains. I've heard plenty say they wish they'd gone while they could. So use the number. It's real, and it's substantial, and it's sitting there. But use it for something. Rules of thumb. 6 of them. 1. It's the gain that's capped, not the amount you can sell. Your basis comes back to you tax-free on top. 2. Ordinary income stacks underneath your gains and eats the rune first. Pension, IRA withdrawals, interest, and Social Security all count. 3. Aim below the ceilings, not at them. That senior deduction starts phasing out at $150,000, and you're only $3,600 away at the maximum. 4. Federal zero is not zero. Your state may tax the whole thing, and the income still counts for Medicare and marketplace purposes. 5. Selling and rebuying resets your basis higher permanently. The wash sale rule doesn't apply to gains. 6. The single filer number is 73,600, just over half. Plan for whichever one of you is going to be filing that way someday. A few honest words. This is education, not personal tax or financial advice. Your basis, your state, your other income, and your filing status all change the answer, and getting it wrong here costs real money in a way that's hard to undo. I'd also say plainly that the senior deduction piece of this expires after tax year 2028 as the law currently stands. So the $146,400 figure is a 2026 figure, and this particular window has a scheduled end date. That's not a reason to rush into something foolish. It is a reason not to assume you've got forever. And if the shape of your money doesn't fit this, meaning it's all inside IRAs, where you've already claimed Social Security, or one of you is under 65, that's fine. It doesn't mean you failed at anything. It means a different set of tools applies to you, and most of them we've covered in other videos. Let's pull it together. The $146,400 is real, and it's 4 layers. $32,200 of standard deduction, $3,300 for being 65 and over, $12,000 of senior deduction, and $98,900 of 0% capital gains room. It's the gain that's capped, not the sale, so the actual cash can be far larger. It works for a married couple, both over 65, with a taxable brokerage account, who haven't turned on Social Security yet. That's usually a window of about 5 years. Ordinary income underneath eats the room. The senior deduction starts phasing out just $3,600 above the maximum, and your state may want its share regardless. For a single filer, the number is 73,600, which is a hair over half, and that's worth planning for now. And the years this works in are also the years you can still do the things you've been putting off. So here's your question for tonight, friend. Do you know your cost basis? Not your account balance. Your basis. How much of that brokerage account is your own money coming home, and how much is gain? Because if you don't know that number, you cannot use any of this. And if you do know it, you may be sitting on a window that's open right now and closes the day you file for Social Security. Go look it up. It takes about 5 minutes. If this was useful, do 3 things for Uncle Vern. Hit that like button so it reaches folks who are in that window right now and don't know it. Subscribe to Ask Uncle Vern so you don't miss the next one. And in the comments, tell me whether you've got a taxable brokerage account alongside your IRA, because that one detailed decides whether this whole video applies to you, and I'd like to know how many of you it fits. I'm Uncle Vern, and I'll keep it at the kitchen table. See you in the next one.